that sound good to everybody?
Sure.
Great.
Perfect.
So yeah, the first view we're looking at is a bunch of indices. So this is across many different indices to see what's been happening since January. So it's the percentage return from January 1st to today. And all of these are interactive, so you can click to see the percentage change between these points. And so we see this big dip here in mid-March. And then what we can start to layer in is the actual portfolio. And so what I want to look at first is the actual portfolio of the return. So this is the collective returns for that mixed portfolio that we'll dive into. And so we can see that similar dip in March to a lesser degree, but that we end up actually net positive here towards the end with a 26 or almost 27% return since January 1st, which is pretty substantial. Anything further you'd like to comment just about sort of the indices and the overall portfolio?
Yeah, I mean, I think what's interesting. Oh, sorry, Rob, go ahead.
I was just going to comment on the portfolio. I think it's interesting to note. So here's this portfolio. It was in a month before the lows, so to speak, of the third week of March. This portfolio is up 11%. Then it drops, and I think I just did it here, but I think it's down 19%. So think about the magnitude of that drop. That drop for this group of stocks, this portfolio is in 30%, a huge, huge drop in the value of this particular portfolio. Then, of course, obviously, what's so striking is that if you come here to where this portfolio is today, and I'm not sure if I'm quite on the last slide or the last dot there, but it's 26, 27%, and so it speaks to the magnitude. This person, in some respects, you could argue that this portfolio is more stretched even now than it was a month before the lows. And so when we talk about that exposure piece, about where to from here, this portfolio was extraordinarily exposed back here. And now the valuations are such that it's even potentially additionally stressed. And I'm sorry, I spoke over you there.
Oh, no, I think, I was going to make that exact point. And I think the other one, so these indices aren't just any indices. These basically represent the 9 of the most kind of well-received kind of asset classes, not just stock, but overall investing asset classes, what's normally seen in kind of that investor quilt that we talked about. So this really is a broad-based description of what the whole market did sector by sector, whether it be foreign or foreign bonds, or there's a commodity piece in here. The other thing I would say is if I'm an advisor here, and Rob mentioned like, hey, this portfolio is super stretched now, stretched more than it was back in February. This big PX, so this last symbol that I'm looking for here, it's got the price data there. So this is a BlackRock 60/40 portfolio. This is kind of like the, chicken noodle soup, the vanilla ice cream of portfolios that everybody, that traditional asset management for individual investors is based on, 60% stocks, 40% bonds. And so as this portfolio has come out of its March lows, and you're actually up 5% on a 60/40 portfolio, which may not seem as much, but you didn't have as much risk as everywhere else. Relative to this vanilla portfolio, after everything that's gone on, this thing is super stretched even. And so when I compare this point here with the far point over here, if I'm an advisor, if I'm worth my salt or worth the 1% you're paying me, I'm saying we got something going on here that we need to look at. And, this looks great, right? You got more money, but, something really, we have to examine why we're stretched over this basic portfolio here, because for 95% of all investors, they probably shouldn't be.
Yeah, really interesting point. And so let's, actually expand out this portfolio to see the component parts. And so we'll build out these component parts here and looking down the axes, and we can see what's comprised. And I'll move to the next step after this, which we can actually see the actual allocations. And I think to your point earlier, that we're overextended in certain assets. That we'll want to reassess. But before I jump further, any commentary on sort of this, on the actual funds that are making up the portfolio?
Yeah, so you have both some index exposure, but then you have also this individual name exposure, these individual stocks, right? And so of course it's in large part, as you can see, these sky high returns for Tesla, which note that, just because Tesla has gone up so dramatically since, the third week of March, that doesn't mean that it wasn't exposed on that downdraft, right? So there's Tesla from down 16% on March 18th, but note, Tesla was up here over 100%. So like, just because Tesla's doing so phenomenal up here, same point just made, as we were discussing before, it relates to the entire portfolio, but just made all the more extreme in this one individual name. Tesla too, extraordinarily exposed then, and who's to say, right, that the same sorts of market factors that were clearly, affecting all these names and all these, across the board, all these indexes, these funds, these individual stocks, that those same forces couldn't come back to bear to have a huge impact. So yeah, the outperformance in part, even though I think, as I recall, Tesla is only a 5% portion at the outset of this portfolio. Right now, it's a meaningfully higher percentage of the overall portfolio than it was then, which is what gives us some of the exposure we were talking about on an overall basis.
Great.
Obviously the outperformers jump off the page to me. And also of note, just as you're talking about what kind of economy are we in now and where's the market going, some things are rocketing back. Amazon continues to do well. Where are we at here? Like your QQQs, your NASDAQ is at all-time highs. That's at the far end. And yet we've got other areas here where, still in the red, still down on the year. So like there really was a big bifurcation in March, April that, while has come back a little bit, we still have like very wide dispersion of results and returns across this portfolio, which is just basically kind of index portions of Vanguard ETFs. And so it'll be interesting to see, as we get the portfolio weightings and how things shift. But, something that just this shows great, like the greens, the reds, the yellows, the skyscraper over here with Tesla, the basement and the gutter over here with what's still knocked back. Like, wow, Phil Morris hasn't come back. Wow, the VNQ hasn't come back. I think that's one of the foreign allocations, emerging markets. So, just that dichotomy shows great here.
Yeah, no, you can really see it clearly. And speaking of sort of the portfolio allocation, these are the weights. And so I pushed everyone over to the end of the weights, but here are the start of the weights. So starting on January 1st, we can see the asset allocation here. So Tesla as a sort of a quintessential example, starting at 5%. But that by the end, we're at 13%. So more than doubling the actual allocation in the category. But then, some like QQQ, 25% of the whole portfolio, and relatively stable over that period, and some decreasing. So PND over here. And so, I think it's been really interesting to see sort of where we end up in terms of the allocation and how that's changed over time. And, if you're making a decision, I'd be really curious towards what recommendations you would typically give at this point, looking at where things are allocated and how to rebalance someone's portfolio.
Yeah, this is great. I'll just jump in really quick because if you're an advisor, especially when you're talking about an individual advisor, and you got people that on one hand you want to put them into some sort of model portfolio, you want to show them that basically the only free lunch in investing is rebalancing in some sort of regular time frame, whether it be semi-annually, annually, et cetera. You certainly worry about concentration risk in a portfolio. So when you met at the beginning of the year and, you told your advisor, yeah, I still want to be long Tesla. I still want to be long Amazon. My grandma gave me Philip Morris and, some Apple. And you said like, all right, well, let's not make any one individual stock. Forget about the technology concentration for a moment, but let's not make any one individual stock over 5% allocation. Because, you never know what could happen. We've also lived through Enron, and, this portfolio for risk should not be all consumed with one stock. Cut to the end here, and you're sitting here with, stocks, and I'm sure, that's the rule of thumb is 5%, but any individual advisor is going to have their different rule of thumb. But, you have Tesla at 13%, you have 17% bonds, which is probably, too heavy right now just because bonds have lagged. These numbers get pretty big. So like this is flashing, concentrated risk, and it's flashing rebalance opportunity. And if you were coming and having that quarterly meeting with your client, you would be saying, hey, look, we started out here, but like, look at how these weights are different now. And, you risk giving back a lot of this gain because of your good fortune, frankly, and how your portfolio is outperformed. But now might be, and by rebalancing, what are you doing? Well, you're selling this up really high, and you're buying, something down here in the red that's decreased to get it back up to its target value. So it creates that natural sell high, buy low, which over time is the type of investor behavior, frankly, that you want to support. And it's actually the exact investor behavior that retail, doesn't follow. They buy high and they buy higher, and then they sell after a huge drop, which, is counterintuitive to anybody who's been involved in the market.
Yeah, it's tempting to see the increases in Tesla and Apple and buy into that fear of missing out, more or less. And I think your more pragmatic approach is it's very illustrative here. Actually, I think it's actually really clear to see how some things that have gone down and are a tiny part of your portfolio, that's really some of the opportunity areas in many regards. So
yeah,
I think you're totally right that we've all sort of been fortunate to a huge degree, and that luck won't necessarily always continue, and how to be prepared for that risk moving forward.
And for your purposes, Michael, just to say, like, if not per prompt action, it prompts the conversation. So you could say to yourself a very reasonable thing, hey, we're underweight energy right now. So now you could have reasonable people will disagree whether you should be trying to get energy back up to some original target. Because things have changed a lot. Things have changed with air travel, have changed with automobile travel. And, we're in a different regime. And so having it sit out here makes you have those discussions, if anything. So prompts action, but it's just, let's make sure we want this to not buy this. And how would we reallocate that in future changes?
Yeah.
Rob, what would you add?
There's only one thought that I would have, and you've made it, I'll just say it in slightly different words. So if the discussion that Ed pointed to was this individual name risk that exists, and it's appropriate to think about that as it relates to any given stock, any given name, Apple, Amazon, Tesla, Morris here. But there's also an aspect of it, which is what's the collective exposure to these individual names. And so it starts out at 18% between those four, and it ends at 28%. And that is a meaningful difference. If I'm just adding up the 2, the 6, the 7, and the 13% from those same four stocks. That in and of itself, just your total exposure to individual name risk, individual stock risk is important, particularly when these stocks are one would say that they're relatively highly correlated on the technology side. Morris is obviously a different type of exposure, but just going from 18 to 28 is also in total is a worthy. I mean, it's almost 30% of the portfolio now are in these individual stocks.
Yeah, you can't make up these stories. I mean, part of me feels like sometimes I look at this and it feels like fake data sometimes, but this is the real thing. What's going on in the market, and it's pretty wild. And I think we're yeah, all need to make big decisions here. But you know, maybe to Jim and Jason here, you know, having not really spent as much time in this and being some of your first exposure, you know, curious to get your thoughts and reactions and any questions you have for Rob and Ed.
Yeah, I mean, you know, go ahead, Jason. I've got a couple of things.
It's stunning to see Tesla. I mean, we know the numbers, right? We're used to hearing the numbers, but to actually see what, you know, 282% looks like, just gives you a feel that's really crazy and meaningful to me. I think this is just like a stunning view, right? It's such an interesting comparison between the index funds and the portfolio. And yeah, I mean, wow, if this is the way that we can have conversations around data, you know, Flow's new little watch phrase is collaborate around data, and to see, you know, 5 other avatars around me all interacting comfortably, selecting, exploring, and having this conversation is really exciting to me. It's stunning.
Yeah.
Jason, let me add to that thought that you just voiced about Tesla. So if you think about like what is so much of the media, the financial media focused on, I'm not saying they're not focused on Tesla, although when people focus on Tesla, a lot of the times it's about Elon, right? But a lot of the focus with respect to stocks is on Amazon, right? And how well Amazon has done given the pandemic. But then if you actually go out here and you see that the magnitude of difference between Amazon, which has obviously done great, don't get me wrong, but you then look at it by the comparison to the point you're making around like just how high Tesla has gone, and that 200 and whatever % would look. I mean, think about it from this data point down to here, right? The Tesla fall on March 18th or 23rd or whatever date that is. That, you know, it would March 18th. It would be, you know, even more pronounced if March 16th or March 18th was our starting point.
Right.
Yeah,
Well,
Michael,
Jim, you had a few.
I was just going to say, there's a couple of things. First of all, being on the outset of this with you a couple of weeks ago, my mind's kind of blown right now because we had the prototype set up, and then you layered in the allocation on the portfolio, and from a graphics viewpoint, which is for better or for worse my background, it's delightful. It's surprisingly delightful to see to easily so digest the layout of the portfolio against the various assets. So yeah, this is a really nice exchange. The other thing was I was trying to put myself in the shoes of the client, right, the investor, and how I would absorb this information, and it's pretty readily absorbable. I mean, I'm focused, right, and I'm having discussions about particular assets, and my eyes aren't glazing over of 80 pages of a stack of PowerPoint or whatever. So I'm really enjoying the focus here as well, and that's sort of the graphics take on it. But yeah, nicely done.
James? Yeah, I find it riveting. I spent a really long time searching for just other visualizations to like not copy, but to draw inspiration from. And to be honest, it's actually pretty hard to find anything that really collectively brings lots of information together in a digestible way. And I think to the point that, you know, Ed and Rob have really championed, it's this idea that, you know, how can we engage an audience, especially remotely, but more a younger audience that wants to understand this better. We're sort of in the Robin Hood generation. And to that degree, just having more compelling graphics, a better way to communicate around this data and to draw insights, I think it's totally on the right track. So I'm really excited to see where we can take this. And yeah, this is really fun. I mean, we got 6 people here. We're talking about real content, and it makes me think about my own portfolio. So
Same here.
It's good to, I think we're all going to be talking with our brokers here soon.
Michael, if I could pick up on one of those thoughts Jim just said about the 80 pages. One of the problems with the,
Yeah.
I mean, aside from the fact that it's 80 pages, right? It's of course easily glazed over, and it's always rushed for time, and people are rushing you through it. One of the problems is you get to page 49, and you've kind of lost what was on pages 5, 6, and 7. And I think that's really the essence of what you've done here, Michael, is that you've put all 80 pages into the view.
Yeah.
So, right, you let us layer it on top of one another, layer each piece on top of the previous pieces, but we can still talk about whatever, some data point over here that was on page 12. And we can still talk about this, 13% exposure to Tesla here, which is back here on page 66, of what would be a common DAC. And that's really important because it allows you to absorb the information in a non-linear way, non-sequential way.
Yeah.
There's two things you've just hit on. If I can just be obnoxious enough to do a little bit of a meta-analysis. One thing you did with your pointer is you said, over here, look at this, and compared to over here, look at that.
Sure.
And just with your pointer, we all knew exactly what you were talking about. You didn't need to be technically, if you were a client who doesn't know the technical terms to use and can communicate effectively with his technical resources with words like this and that, that is incredibly efficient.
Mm-hmm.
And then the other thing is
back 40 pages to find those data points.
Right. Well, that's the next point that I really appreciate. There's being able to maintain the mental context from step to step to step is really crazy important. And every financial conversation I've ever had in real life, I feel like I'm always missing that context. And even when I sit and go through portfolios myself, I'm constantly having to open up dozens of browser windows in order to keep track of now what was this stock doing and what was that fund doing and mentally you've got to build all that 3D mental model in your head. If you can then share that mental model more effectively, more quickly to someone else, and of course have it more clearly identified in your own head, that's where you start to get these real vital gains in shared cognition, shared understanding.
Right.
Yeah.
The other thing
and I think
is
go ahead, Jim.
I have agency here. Like I can move around it, and if I get interested in something, I can go to a different angle. I don't have to sit and flip back through the PowerPoint or whatever it would be, right? I have agency to move about this and focus in on what I find most interesting at any given time, which is pretty cool.
Yeah. This is exciting, and I think as we think about where this ends up, the thing that's not here that I think will be interesting to start to layer in is like more the predictive. Where is this going? Where do we think this is going? And I think that was the thing I didn't quite get to yet. I know we talked about extending this out for the end of the year, like what are our expected returns for the end of the year. And I think layering that piece in and the decisions that you have to make along the way and helping guide people along those decisions takes it to that next level. So right now we're having like an understanding, a conversation about the current state. And next, it's sort of, all right, let's start to run some models. Let's predict what we think is going to happen. And then it's more of, scenario planning. And I think that's where this conversation eventually leads to.
Yeah, and Michael, that bears itself like any advisor is going to give you, okay, here's your year 9 months out. They're going to try to make a lot of these discussions are around risk assessments. And they use very complex modeling that, what eyes would glaze over for 99% of all investors. But they will run scenarios. They're going to run you a market down 20%, volatility up to 15%. They're going to run you a, let's look if we see returns similar to great financial crisis. They're going to run you a, let's see what happens if the NASDAQ crashes again like it did in 2001. And so each one of those can be, they'll have the data for it because they'll run through the model. But just to be able to just one by one in a line, plot this portfolio. Here's our portfolio, and you're sitting here, and then what happens in all these scenarios, Mark it down 10%,
Yep.
mark it up 5%. What if there's a, we go back to where the Russian ruble devalued back in 97, all these historical things that have tons of data next to them, and we know how stocks performed. Like that's that great conversation around, and here are scenarios to visualize what happens when these type of shocks. So are we comfortable with that risk we're taking?
Yeah. That's perfect. This is exciting. This is awesome to me. I don't know how else to say it. This is really, really fun to go through together. And hopefully you guys are getting as much value from it as I am. It's been fun to do. And actually, to your point of the more complicated analyses, I actually started to play around with the covariance and correlation matrices, where you can look at the correlation of all the stocks and compare them to the indices to see what's moving with what. So to try to find that efficient frontier. Mapping efficient frontier in more than 3 dimensions is really hard to do. So anyways, I didn't quite get around to really making it into this, but I think there's some other exciting things that we can start to layer into.
Michael, can I add another thought? Just it's not on that point, but on the correlation point, which is certainly a relevant one. But I think there's a natural tendency sometimes when you look at when you have the opportunity to look at something like this in maybe 3D space, is to stay above the 0 line. And actually, Flow gives us a really quite amazing ability, not unlike, think of the sea, right, or the ocean, to actually kind of go beneath the surface here. And, I think we did this before, Michael, and I'll just do it again with the other guys here. But this notion of like coming down to where I think that's Jim on the other side of me, maybe, to be able to come here to March 18th, or March 23rd, or whatever this day is, where everything's making these lows, and just like you don't need to necessarily line up and know, okay, well, gee, this data point is EEM and this one's EFA and so on. But the ability to see how widespread the impact was of that downdraft, right? Nobody was spared in that, and you can really grasp that when you come down to like this point I'm at, or I'll get out of the way for anybody else who wants to do it, but or on the other side, which if you kind of just stay up here, you kind of lose that. You kind of lose that insight that's there beneath the ocean's surface, as it were.
Yep.
Yeah. Really good point.
Yeah. I mean,
all right.
I love going below the line, below the surface of the water. I think is really fun.
I think I just
Mariana Trench of portfolio returns.
Yeah.
Wow. All right, guys. I think we captured quite a lot of good stuff here. And